Welcome back. This is part 2 of our 8-part explainer course. If you were with us for part 1, you've got the foundational mechanics of the options market down. Today, we're taking things straight from theory into practical application. We're handing you the tactical map of the options battlefield to show you exactly how mechanical dealer flows dictate price action. Teacher to trader, direct, and numbers first. Today is purely about what a GEX ladder shows, how to spot walls and trapdoors, and why prices mysteriously pin on expiration day.
Our briefing today covers 5 main things: the GEX battlefield map, cushions and trapdoors, the gamma flip point, our 3 GEX honesty rules, and finally, expiry pinning and max pain. Let's get right into it.
All right, starting off with Section 1, the GEX battlefield map.
So what you're looking at here is a GEX, or gamma exposure map. GEX basically aggregates, strike by strike, exactly how much delta hedging dealers are forced to do for every 1% move in the underlying asset. It's plotted as this ladder of bars by strike. Honestly, think of this as your real-time topological map of market friction and acceleration. You have to remember, dealers don't have opinions, right? They just have inventory. And the bars on this chart represent the forced, predictable flow of their hedging. When you look at this ladder, you aren't looking at some standard support and resistance based on past price history. You're looking at the live mechanical forces that are going to actively push against the market or accelerate it today.
Now that we have the map, let's look at Section 2, cushions and trapdoors.
The map is divided into 2 totally distinct zones. First up, we've got positive gamma walls. These act like sticky magnets and cushions. See, when dealers are net long options, which happens a lot when customers sell tons of covered calls, their hedging is counter-trend. If the price goes up, they sell. If it falls, they buy. This means large positive gamma strikes sitting above the current price will actively cap rallies, and the ones below will cushion the dips. The market basically becomes this mean reversion machine. But then, we have negative gamma strikes. These are entirely different beasts. We're talking instability zones, literal trapdoors. When dealers are net short options, their hedging becomes with trend. If you drop below a big negative gamma strike, every single tick down forces more dealers selling into that decline. These strikes actively amplify downside momentum. Moves extend, they overshoot, and they accelerate violently.
And separating those 2 opposing forces brings us right to Section 3, the gamma flip point.
This is the exact price level where the dealer book aggregates literally flip from net long gamma to net short gamma. Look, the gamma flip point isn't just another arbitrary line drawn on a chart. Crossing it literally changes the underlying physics of the market. While you're above it, you're in a dampened, range-bound regime. Dips are bought, reps are sold. But the second you cross below it, you enter an amplified, trending regime, where the machine is actively pushing the trend, and daily ranges can suddenly double. Crossing that flip point means the market stabilizer just became an absolute accelerant.
Now, to keep you from blindly trusting bad data, let's hit Section 4, 3 GEX honesty rules.
The crucial thing here is that a map is only as good as the person reading it. These 3 honesty rules are going to keep you grounded. Rule number 1, the dealer's sign, meaning whether they are actually long or short gamma at a specific strike, is an assumption. Standard GEX maps just assume dealers are long the calls and short the puts that customers traded. It's a solid default, but it's wrong often enough that it matters. You absolutely have to cross-check your map with actual price action. If a supposedly massive support wall just gives way instantly without putting up a fight, it was mislabeled. Rule number 2, expiry matters. A massive wall built out of tomorrow's 0 days to expiry open interest, that literally vanishes tomorrow. A wall at the monthly OPEX expiry, on the other hand, is durable for weeks. Always quote your levels with their expiry date. And Rule 3, walls are zones, not exact lines. Dealer hedging is distributed across the market, so you need to treat a wall as a region that's a few bucks wide, not some penny-perfect boundary.
And that time decay leads us perfectly into Section 5, expiry pinning and max pain.
If you have ever watched the market mysteriously hover right around some massive round number on a Friday afternoon, you've witnessed expiry pinning. And no, this isn't some grand conspiracy by market makers to screw retail traders, it's just pure hedging arithmetic. As the time to expiry shrinks down to 0, the gamma at the money strikes absolutely explodes. It gets enormous. If dealers are long that gamma, they're forced to aggressively fade every single intraday wiggle away from that strike. They're selling slightly above it, buying slightly below it just to stay market neutral. The direct result of this massive forced flow is that the price literally gets physically pinned in a tight orbit around that huge strike, right up into the close of the day.
Which naturally brings us to max pain.
Max pain is the specific strike where outstanding options will expire with the least total value for the option holders. Price actually does drift toward these high open interest clusters into expiry, and it's because of the exact pinning mechanics we just walked through. Max pain provides a really crucial context signal for this expiration drift, helping you spot the strongest magnets on the board. But a quick warning, it should only be used as a magnet hypothesis that you confirm with your gamma map. Never ever use it as a standalone trade purely based on the number itself.
So let's summarize how all of this builds into an incredibly actionable framework. You're going to want to memorize this cheat sheet. If you're approaching a positive wall, the mechanical action is a cushion or a magnet. You can expect counterflow that dampens the price and caps the move. If you're approaching a negative strike, the mechanical action is a trapdoor and an accelerant. Expect with-trend dealer selling that will violently amplify momentum. And if you're approaching the flip point, you are approaching a total regime boundary. Crossing it changes the market from dampened to amplified or vice versa. Instantly knowing these three levels lets you anticipate exactly how the machine is going to react the second price arrives.
So this map gives you today's absolute edge. It shows you the exact footprints of the options market machine right now. But what happens when the volatility surface shifts? What happens when fear spikes, the cost of insurance moons, and the Greeks dynamically rewrite all of the rules overnight? That's exactly the mechanic we are breaking down in part 3 of this course on the volatility surface. Until then, keep an eye on your maps, respect the flip point, and don't fight the pin.